Hi, everyone. Welcome to this conversation on Mango Spaces tonight in partnership with IPF. That's the Institute of Public Finance. In the next hour, we'll focus on trying to answer a deceptively simple but much more detailed and complicated question. Kenya, of course, does plan to spend just under 3.5 trillion shillings on recurrent spending, around 850 billion shillings rather, on much needed capital projects between July this year and June 2027. And to pay for all of that, they expect to be able to raise about 2.9 trillion shillings in taxes from you while borrowing another 1.1 trillion Kenyan shillings. That at least was the broad spending outline that the Finance Ministry put out back in February. But stepping aside from the numbers, the question is this: are we funding the right priorities in education, agriculture, healthcare? Those three issues, we'll focus on those tonight. In the decade to 2023, for example, the number of undernourished Kenyans went from 18.9% of the population to nearly 37%. And this is in a country where we have an abundance of some crops, some commodities. Milk, for example, we produce an enormous amount of it every single year. And as the 2025 Economic Survey indicated earlier today, our purchasing power, you and I, you'll see this every time you go to the supermarket and you try and buy something, right? Our purchasing power is still well below where it was in 2021. So with this very limited space to raise revenues and a massive range of public services that we do need to deliver, what should your very limited taxes be spent on? We'll explore some ideas with our panelists tonight. The economist Stephanie Kimani is joining us on this panel. We also have the health economist Dr. Pizangohio, and a little later on we'll also have the research analyst Martin Kabai joining us. And of course, the latter two are coming in from IPF, the Institute for Public Finance. Dr. Ngohio, I'm going to put you in a slightly interesting spot because Martin isn't here at the moment. But I want to start with a bit of background here because the shadow budget document has been prepared since, I believe, fiscal year 21-22, right? What's the policy objective in putting this pitch together, and have ideas from it been translated into policy over the last 5 years?
Thanks, Rama. Thank everyone for joining this session. But it's an instrument that you can use to help Mwananchi understand more about the technical document, but also an instrument that you can use to provide an advocacy tool for Mwananchi to argue for a certain priority. So it provides you, for example, what could be a suitable budget based on the priorities that have been stated, vis-a-vis what has been done in the past. So it provides a picture of what could be. So it provides you with an opportunity to counterfact to what currently presented. I think this should be in the seventh or something that I have read, to be honest, because I haven't been deep reading into the budget author. About 3 years ago, when I actually caught the interest, because there was arguments about the increased resourcing for help and what that could do vis-a-vis what was currently being prioritized. So like in this particular version, I think there have been an attempt to focus on specific areas. So there is a focus on women empowerment, there's a focus on social protection, there's a focus on climate change, there's a focus on health in this particular version of the shadow budget.
There's a ton of information in there that actually does make for quite interesting reading. Stephanie, some of the things that IPF is talking about, ideas that we've spoken about in some detail before, there's this huge gap between what the government publicly will commit itself to doing versus what it actually does choose to spend money on. And IPF is flagging over-optimistic revenue assumptions, duplication and spending that in some cases is very difficult to track. Why does this pattern in our public finances still persist, and what can we do to fix it?
As the IPF shadow budget has correctly seen, is that yes, that there are gaps between the commitments and the actual spending. And these gaps tend to happen within Kenya's context, raising a budget credibility problem. First, as they have mentioned, and we've discussed prior, that the revenue assumptions are too optimistic. And if those revenue collections underperform, we see that the government adjusts through either budget cuts, which primarily are in the form of cutting development spending. We're seeing arrears, such as the unresolved issue around pending bills. We're seeing higher borrowing, which tends to be local, and or new taxes or adjustments in the tax structure. And another reason why there are these gaps is because also recurring spending tends to be quite rigid. We have debt service, wages, and transfers, which are quite difficult to cut quickly. And as such, these rigid obligations now absorb that largest share of that spending, crowding out public investment. Another thing, just as I've mentioned, is around the fragmentation. We are seeing that there's fragmentation around health, the school feeding program, bursaries, drought response, all that. And they sit across multiple agencies. And this creates, as I've mentioned, the duplication and the weak targeting. First, what the government needs to do is just be conservative in their revenue forecasting. And that's the main part for myself. Conservative revenue forecasting will help them a great deal because that's where the problem lies. The whole budget is pegged on the revenue forecast. And if those revenue assumptions are not met, the budget suffers. So that is a key goal. Just be conservative on the revenue assumptions, look at the reality on the ground, and then work your way around that.
So can you give an interesting analogy around that revenue assumption? It's essentially like saying, I wish that my salary is 1 million shillings a month. And yet in reality, I know in the past, the most I've been able to pull off is maybe 200,000 shillings. But all my spending plans, my current and my development spending plans are based on that wishful thinking that I'm going to make this 1 million bob in revenue. Therefore, I can spend that much money, right?
Yes, yes.
Yeah, which really doesn't get us to any specific space. With respect to some of the things that we're talking about in terms of the rigidity in spending, wages certainly comes up over and over again as a key pain point. So does debt service. Is there any wiggle room at all there in terms of debt service? Because that would by itself imply a measure of restructuring. And on the wage service side, it would imply we'd have to downsize the size of the civil service.
I'll say this cautiously, especially around the liability management side of it, like you've mentioned, because you can't just do away and restructure immediately. Interest payments over the last, I think, 3 fiscal years have doubled. And I think there's going to be an additional over 300B that will come in the next cycle, 26-27. And majority of that interest or domestic debt, let me start with domestic debt. Domestic debt is held by banks, local banks, pension funds, local insurers, SACCOs, and households the same. So any disorderly restructuring I foresee would threaten financial stability in totality. So in terms of trying to figure out how we can play around the debt service issue, these are things that are currently being done. And one of the things I keep saying is that the government is doing the work. There is work that is being done. Whether this work is publicly appreciated or communicated so that there's trust in the system is another thing, and that's what's been put to question. So the approaches that the government has taken and which does work is around lengthening the maturities and also smoothening those redemption peaks. And what I mean by this is that they try to avoid a situation where there's too much government debt that matures at the same time. And obviously a big thing is on reducing short-term refinancing pressure. We're seeing a lot more pressure around on short-term aspects, avoiding excessive reliance on short-term papers like treasury bills. That's where majority of people play because there's an issue around investor trust going forward, as well as deepening the secondary market, which is actually something that is being worked on currently. And also something that we've seen in the past couple of years is around introducing buyback and switches, which would help where the market would be able to allow for this.
Well, I want to pivot to one of the things that the shadow budget from IPF are focused on, especially with healthcare. And I'm sure for a lot of the Kenyan listeners who are on this particular space, they'll be looking at their pay slip and looking at the amount of money that is being deducted for healthcare contributions through SHA, the Social Healthcare Authority. And they'll be asking themselves, where is this money going? Where's the value for money? And one of the interesting observations that this report makes, Dr. Mohio, is that health financing is still highly donor dependent, and it's exposed to both fiscal and transition risks. And some listeners here will say, but SHA is collecting over 140 billion shillings. Why do we still have a funding gap?
So yes, our country relies a bit on external financing for health. I think the trend of overall spending for health has been constituted mainly of domestic government spending, about 50%, heading towards 60%. And 21% right now, I think, from the latest estimates from WHO, based on 2021 data, actually, was externally funded, more externally sourced. But the trend has been actually improving. The domestic funding has been increasing. External funding has been reducing. And this is not only because of global trends, but also because of the effort in country to try and move external funding from off budget to on budget, which actually means that the budget increases for the proportion that is visible in cases. So, for example, as far as budget flows are concerned, in 2023, I think it's estimated from the budget documents, if I'm not wrong, based on the health sector resource mapping and effective tracking report on 2025, 95 billion was from government of Kenya, about 29.8 billion on budget donor, and another big chunk, about 71 billion of budgets from donors. Total about 100 billion from donors. contrasted with about 95 billion from GFA. This is for what can be seen from the national level budget. This doesn't include funding through county, because remember, county funding for health comes partly from the overall allocation that the county gets, partly from conditional grants from the national government, partly from preparations in AIDS, i.e. FIF for NEPSENT and come out the partly from arrangements that they have arrangement with other donors like the CDP in the past, with US government, and so on and so forth, with global funding for some areas, and so on and so forth. A number of off-budget supports that may happen from national level or may happen from county level. Basically, what can be seen on the budget, which is a chunk, not the entire amount that flows to health. What can be seen on the budget seems to have been, for 2023, about 50-50. But this has changed. You will notice, as the report says, that there have been an increase in allocation towards health by the government. So domestic government are allocating towards health. Seems to be increased. In 2025-26, I think the anticipated amount was about 135 billion. From what we had paid in 2023, about 95 billion. And there is an anticipation, according to the NTEC, this amount might go up to about 165. And then remember that this doesn't even include the discussions that are going on right now about channeling more money towards primary health care. So SHA controls 3 funds. There is a primary health care fund. There is a social health insurance fund, the one that is now contributory. And then there is emergency chronic care fund. And these 2 funds, PHC and ECPIF, are actually government funded. They are fully tax funded as of now. And there was an anticipation that we would have more donor funding moving towards these funds. And I think there are discussions going on. I think right now the implementation arrangement for the government to government deal with the USG. I don't know whether these actually will see the light of day. And proposed initially that some of the funding goes output-based purchasing health services using these PHP funds to promote the idea about integration and improve efficiency and to reduce these whole funding processes that have been causing a bit of duplication of effort and so on and so forth. So there seems to be an attempt. That doesn't mean that we're having enough funding for health. Globally, if there's a reduction in interest from overseas development assistance towards health specifically, there's a push towards thinking about market systems, not towards thinking about aid for trade, moving from aid to trade. As a thinking towards moving towards financial alignment. So the country is conscious about that. And we see effort in these budgets to try to consolidate, to try and make sure that funding is visible and it's moving.
Let me just step in briefly there, because ultimately, I think a lot of people will be listening to this in 2026 and say, hang on a minute, what's the total resource envelope that we actually need to fully cover all our healthcare needs and not be reliant on other people's money, especially on programs that are identified in this report? HIV and AIDS, malaria. Malaria is endemic. It's a tropical disease for the most part, right? It's not really something that the West are dealing with. Reproductive and maternal health care issues. Surely we should be able to fund all of these services ourselves, right?
And that's a derived position, to be honest. But I guess that there are competing interests also. What I mentioned earlier about the fiscal constraints that the government budget faces is that in reality, we're actually paying a bit of amount towards debt. The debt comes first in terms of prioritization, especially public guaranteed and public debt. You have includes guarantee. And that repercussions to not meeting these debt repayment schedules. That constrains the budget quite a lot. There's also the whole idea about prioritization. That is actually health is a priority. And this conjecture, I'm not saying to a fact, but unfortunately, conjecture here's that the way we spend our resources, especially as we head towards the electoral period, shows a different prioritization than necessarily meeting social needs of the population. And this is not to fault the government, it's probably a system you can fault in one way or the other. I don't want to waffle it all about that. Clearly, there are other priorities that seem to emerge beyond these priorities of health and foremost. But to be honest, like looking at a decade-long view, it seems as if health has gained a bit more than this priority. Whether that results in us meeting the outcomes required for health, that's another question.
It's certainly, and some of the key indicators that we'd look at, if you start asking yourself, are we on track, for example, in terms of reducing the percentage of adults, for example, who report having hypertension, right, to much higher blood pressure for both men and women? We're off course on that. In terms of dealing with obesity, both in men and women, we're off course on that. In terms of dealing with diabetes on both genders, our sodium intake, we're off course on that. And of course, some of the stats that I mentioned a little earlier with respect to undernutrition across the board, which at face value seems like an agriculture problem, but it also does have implication in the whole sector. We're not making progress in the right direction. I should point out that we're now also joined on the speaker panel by another economist, Veronica Ndagos, who's joining us here. She's part of the team at IPF. Veronica, you've been listening quite patiently to this conversation so far. And one of the interesting things for me looking at the report was that there were a range of tax proposals in there in terms of answering the question of, okay, if we want to spend more cash in healthcare, it has to come from somewhere. And some of the proposals included ring-fencing the proceeds of raising sin taxes on products like tobacco and sugary drinks, wealth taxes as well. Walk us through the broad overview of how these tax policies would work.
Thank you, and thank you for hosting us. Stepping in for my colleague Martin, who had some technical issues. As you rightly put it, we have proposed some tax proposals within the shadow budget, and I think broadly is to look at areas within our taxation framework of where we can generate additional resources. So beyond doing budget analytics through products like the shadow budget, we also do a bit of research around taxation and to see whether there's scope for either expanding the tax base or introducing new taxes. And this is where these tax proposals are coming in. We have been working with other institutions looking at whether there's potential to tax wealth in Kenya. And this is primarily drawn from the fact that the government has not been able to draw as sufficient taxes from, let me call them the wealthy, primarily because they do not necessarily earn incomes but hold most of their wealth in assets. And that's how the concept of wealth taxation comes in. And also we feel like taxes like rental income tax have not performed very well. Capital gains has had its issues. We even saw recent amendment. So that's where the conversation around wealth taxation comes from. And also looking at our debt burden, we may not be having sufficient revenues based on our current tax system to continue servicing debt and also funding priority areas like health. And around wealth taxation, estimates by Oxfam indicate that if we were to have a modest wealth tax, a maximum of 2% on net wealth, that would generate up to $1 billion USD in revenues. And this would cover some of the financing gaps we are seeing in health sector and other sectors that we covered within this year's shadow budget. Other than that, there's a whole lot of research around tobacco taxation, and WHO holds that Kenya is not taxing tobacco products sufficiently. And so they recommend taxing tobacco products at around 70% of their retail prices. And for Kenya, we are at around 30 to 35%. And so if we got to 70%, then would double taxes that we collect from these products. And this has the justification that consumption of tobacco also puts a strain on our health system. And so it makes sense to earmark some of revenues to health programs. Other than that, we've also done research on tax expenditures. And of course, there's a whole debate around how Kenya estimates its tax expenditures. And this is the revenue we forgo through tax incentives. Recent estimates reduced the tax expenditure estimates from around 500 billion to 286 billion. Our position at IPF has always been some of these tax incentives are justifiable, and especially those that cover basic commodities like food products. Unga in Kenya is one of those products that is exempt. And it makes sense because then we support poor households to afford food. But then we have other incentives that are supposed to spur the manufacturing sector, grow employment, and other incentives we give that are not very justifiable because they have not resulted into increased employment and as a result have not contributed to meaningful income for households. And also looking at it in terms of, for example, there's a wide range of incentives that target the manufacturing sector, but this sector has been shrinking. Then the question has always been, should we still continue giving incentives or where would the problem be?
If I may just interrupt you there briefly, Veronica, with respect to the wealth tax question, because we often hear that term being thrown around, but I think it's incumbent on us to provide a bit more clarity on what we mean when we say we need a wealth tax. So when we say we're taxing wealth, what are we taxing? Is it capital? Are we talking about equities and bonds? Are we talking about taxes on land, on hard assets, physical assets like houses and so on and so forth? How would we implement this in an economy like ours?
I think you listed some of the asset classes that could be targeted through a wealth tax. But then I think to notice that a wealth tax is on net assets. So I think the best example I would give is the wealth declarations that are filed by our public servants whenever they're getting these high ranking appointments. So they always declare their net worth. And some of the questions you usually ask is, how did you get there with your pay, for example, because salaries are well known. So it means then they're able to accumulate assets outside of the normal incomes visible to KRA. And so these asset classes, including wealth that is held offshore. And as I mentioned, I think the most important concept or justification for our wealth tax is that unlike we, the ordinary Kenyans who depend on our monthly income, the wealthy are able to hold their wealth in assets, and targeting them through normal income taxes, then we do not effectively tax them because assets are not exactly taxed in Kenya unless when they are being transferred. So because they are able to plan their tax compliance and shift their income from normal employment income to assets, then it would make sense to target some of these asset classes. As I mentioned, we've done a paper in some of the asset classes, and especially those that would result to capital flight. We recommend the exemption from a wealth tax, but I think generally looking at where most of our, let me say, rich or wealthy hold their assets and then targeting those assets, but then being cognizant that we can have other negative impacts like capital flight. So some of the assets, like I would, for example, mention equity could be exempted so that we are not counterproductive through our tax system.
I want to put a devil's argument, if I may say so, to both you and to Dr. Ngo here with respect to the tax policy implementation, especially on tobacco and sugary drinks. Because you've essentially said that, look, on tobacco, the current rate of tax is around 32%. In other parts of the world, it's anywhere between 70 to 75%. And I think a key caveat to the argument here is that we could raise extra revenue by increasing the marginal rate of tax, assuming that consumption remains constant. But for a lot of these products, the consumption is always elastic in response to price, isn't it? So isn't there a substantial risk here that we're essentially going to price out the consumption of both tobacco products and sugary drinks in the market? Peter, you can take that first, and then Veronica can come in.
I know Veronica has much more authority about this question. From what I know, or at least from the work that I'm trying to read a bit about, I guess we need to first agree that it's not necessarily a bad thing for consumption to reduce for something that might have vast health effects if consumed. The question is, to what extent should we be okay with the reduction in consumption? Now, for tobacco, the argument spirals actually, because they might have heard about the UK attempting to ban sale of tobacco products to people 21 years and below, and they are proposing to increase the age limit or the age threshold every year. Such that at some point they want to get to a point where they will not be selling tobacco products. So for them, I think they're saying that the trade-off is such that they would rather lose the consumption on tobacco products. So I think that's a decision that just has to be made by a country, and it's not an easy decision. As far as pricing out, again, yes, it's not in a line, but when you think about it from an equity perspective, there are some wealthier groups that for whom the price is kind of inelastic. The change in excise duty, for example, change in price will not necessarily affect the amount being consumed from more like a lifestyle and business, something like that. While for some group of some quintiles of the population, there is some level of elasticity. So again, it's not like direct or straightforward in terms of what kind of a policy we need to put in place for that. But the good thing again is that there seems to be evidence that shows that there is proper policy to a certain extent to increase taxes, excise duty on tobacco. Despite the fact that often people see excise duty or indirect taxes are regressive, in the case of tobacco, evidence seems to be showing that there is some progressivity that appears in this situation. For sugar and sweetened beverages, research work is still going on. I think a lot of lessons that we are learning are from South Africa, who have been implementing FSB pricing and so on. But I think there are many more improvements. And so it's a question of what policy reform will do in our case. Again, a guarded answer, but an answer that says there may be a reason for it beyond just pricing out.
Indeed. Veronica, do you want to come in on this?
I think Peter covered it. Maybe the other argument would be around the strain that consumption of these products put on our health system. So in the long run, then we end up spending more on health because we have to cure respiratory diseases. So that, let me call it a moral argument around it, reducing the strain. But I definitely agree. And I think tobacco taxation is one of those conversations in Kenya that has evolved. So there is this whole argument around we tax higher than our neighbors. So we have a lot of contraband. So I think a more holistic policy reform that looks at all these issues. And then sometimes the policy objective is beyond revenue, even if the measure is taxation. Putting all these policy considerations on the table and seeing what can best work for us. But then within longer term is fixing some of the issues we highlight within our PFN system. One of the major reasons we are looking towards additional taxation is because of the tax burden. So in the long term, balancing taxation and how we manage our debt, then it would justify some of these short-term measures to at least fill some of the funding gaps we have in our budget.
I just want to add,
Go ahead.
I think we should also be very careful when we're thinking about the health taxes, the sin tax, because we can say that we are taxing, but where is this tax going to? If we are clear and we are directing this and defining what share goes back to maybe health-related screening and all that, I think it will start making sense and people will not feel the pinch of paying that tax if it comes back to, okay, fine, in the event I get, for example, lung cancer because of me smoking tobacco, the expenditure on that has been supported by that sin tax, quote unquote. So I think we need to also look at it from that point of view. What share is defined towards health-related spending from this quote sin tax?
Indeed, and I believe that's part of the reason why the argument that is being made by IPF in the report is, if you're going to make these policies, the proceeds from them have to be ring-fenced. Right, as part of that trust building exercise to say that, look, yes, we are taxing you more on your sugary drinks, on your tobacco, on your alcohol, and so on and so forth, but here's where the money is going. And unfortunately, in our case, the spending track record is a bit more murky. Dr. Ngoki, I want to come back to you on something that we were discussing just off the conversation online at the moment. The sustainability, the fiscal sustainability of SHIF, the Social Health Insurance Fund. Because looking at the data that came out from the economic survey earlier today, the payout ratios here frankly, are astonishing, and not astonishing in a good way. And just to explain to our listeners, a payout ratio essentially is asking, for the sake of argument, if I know I have 100,000 shillings coming in terms of my salary every month, and then I spend 150,000 shillings, essentially we're looking at a quote-unquote spending ratio, a payout ratio of 150%, right? I'm spending 150% of whatever is coming in. And in this case, for the last fiscal year, 2024-2025, SHIF got around 57.7 billion shillings in premiums and spent 91.5 billion shillings in that year. That's the loss ratio of almost 160%. Surely this isn't sustainable.
And that ought not be very surprising. Sure, we have tried seeing trends towards the challenges of NHIF's sustainability. I think in 2017-18, when the HEFREP report was released, there were indications that claim payouts might overshoot beyond collection, but that's a characteristic of our system that we have historically been at funding health system. We attempted to move towards other sources of revenue beyond tax for funding for health for many reasons. It's constantly been demonstrated that the low willingness or ability to pay for contribution to health insurance in the country is just a factor on poverty level. And I think census must have estimated about 34% absolute poverty level. We can't expect a third of the population to not be able to contribute before actually be able to use their entire cost of health of the two contributing efforts. And of course, why we need the government funding portion, the PhD funding, what is really fully government funding to be filled more resources. I think there's an estimate right now that PhD funding needs to get to about 30 billion. We're currently at about 13 this year, right? We're aiming to increase a little bit more. Even if we push in that difference that we are saying that we are losing from donor funding, etc., into the PhD fund, we still need to add more money from donor. We cannot move toward a full contributory system. SHIF on its own, it didn't have a reinsurance mechanism in the ECTIA. On its own, it will not cover the entire health needs. Given that first, a lot of health spending right now is on primary hospital level and secondary hospital level spending. looking at the household health expenditures and utilization, so the majority of conditions can be treated at lower level of activity using funding from the THC fund. But at the moment, the health-seeking behaviors are structured that we are very health-centric. We need to reform the way in which our health system is being provided. There are going to have to be some provider level reforms.
So it'll have to be a mix of both changing the way we are the consumers, for lack of a better word, where we see clinical services, medical services, but also just as important, trying to get as much efficiency as possible out of whatever we do spend at the moment. Indeed. There's an interesting question here from Dorito Hannah that I want to put to Veronica and to Stephanie as well. And here's what she says. Offshore assets are taxed by the government where the asset is. And now if we're adding taxation by the Kenyan government, that essentially would be double taxation. Is there a limit to what we can do in the name of pursuing a wealth tax? And Kenya, of course, has signed multiple double taxation treaties. I believe we have some with the UK, with Mauritius, with the United Arab Emirates as well. I'm not sure about South Africa. So in that sort of context, when we say we want to impose a wealth tax in order to fund these public services, Veronica, how would we pull it off? Because aren't we incentivizing individuals to say, let's try and park some of these assets in locations like Dubai or Mauritius?
Let me give a disclaimer here around the proposal. Of course, there's the whole consensus that we are not taxing the wealthy adequately. But then in our paper, we argue for setting up the administrative structures, such as a wealth register, so that we're able to tell what actually can be taxed in Kenya and what has been taxed elsewhere. And as you mentioned, we have DTAs that address some of these issues. Another administrative process that can safeguard against double taxation is issues around exchange of information. It's already going on in some areas, including taxation of the digital economy. So I think some of these administrative measures would need to be set up first before we roll out. So I think the major recommendation from our end is not an immediate introduction of a wealth tax, but setting up the administrative structures that will safeguard against these issues, including the issue of capital flight that I had highlighted earlier.
Stephanie, anything to add to that?
Yeah, I just wanted to mention things like DTAs. If you can correct me if I'm wrong, I'm not a tax expert. But from my understanding and the research that I've done previously, majority of DTAs are on income tax and not necessarily wealth tax. Not to say that they don't exist, but that's essentially what normally happens. So DTAs may not necessarily cover the assets aspect, and that's why certain countries don't do it. And maybe to avoid the double taxation, if you focus on purely assets, property tax may be the best way to go about it. Property tax as opposed to the overall wealth tax, because some countries, what they do is that they have ranges. So from this band, you pay 0.5% of this wealth net assets level, like that. So maybe on property as opposed to in totality wealth, I think that tends to be more successful or a better entry point around this wealth tax conversation.
Veronica, I want to come back to something else that was covered in the report in a bit more detail. In terms of support measures, school feeding programs, they're a fantastic tool for achieving a whole range of policy aims. Keep kids in school. If they're in school and they're actually learning, you actually end up with much better healthcare outcomes, education outcomes, and better income outcomes as well over the long term, 10, 20 years down the line. But there's some staggering numbers that are in this report. Children benefiting from the program, for example, over the years, under review, the number of beneficiaries in some cases has actually declined. There's a school feeding program that you refer to here that targets 1.8 million children, went up to 2.6 million in 21-22, fell a little bit in the year thereafter. But by and large, many children who are slipping under the net, who are simply not being supported in the way that they should be. Why?
I wish we had a government official to respond to that question, because looking at the data, you can't tell why. Sometimes even the allocations will increase, but then the number of children you target will decrease. So there's the most famous school feeding program right now, and especially at the subnational level, is Nairobi County's Dishina County. But then even in Nairobi, as you put it, we have an estimated 1.8 million children that are food poor. But then the county is only able to target around 314,000.
Which is less than 20% of the addressable target group.
Yes. Then now coming back to the national level in terms of targeting, The focus of most of the social protection programs in Kenya have historically been targeted towards ASAL counties. And so issues like looking at urban poor, including even issues around other transfers, not necessarily the school feeding program. We have often left out the urban poor in some of these programs. And then again, looking at even how their locations have changed over time. You can tell even when increased, factoring issues like cost of food, which has significantly increased in Kenya, then you can clearly tell that we are inadequately funding school feeding. And the question we ask is, how can we better target poor children, not by region, but by the fact that they are poor? This is a personal belief. We can have someone in Turkana, yes, they're in Nassau County. Their school is covered by the government in terms of supplying them with school meals. But then that person in Turkana, for example, in Lodwar town, is actually better off than someone in Kibera. So how do we better redefine our social protection program so that we are targeting the right people and we're actually targeting the needy? And then in that way, we're able to expand the coverage of it. So there's some good things happening, but then a lot remains to be done around school feeding. But we also have seen a few non-state actors come in and partner with government institutions. Politicians as well have come in to set up school feeding programs. But then the bigger question we ask is, once they leave office, what will happen to those programs? So I think there's need to institutionalize some of these programs so that they are not dependent on whom is in office, but then they are defined by the need that is actually there.
Past speaker Martin Kabaya has joined the panel just a few minutes ago. Martin, karibu sana, karibu sana. I know we had some tech challenges in getting you onboarded, but you're very welcome to the conversation. I want to pick up from just where we were having that conversation with what Veronica was talking about, because the report does go into some detail in another segment dealing with bursary spending. And there's a clear case, I think, just my reading of it, there's a clear case here to collapse all of these multiple bursary schemes that we have. We have them at county level, you've got them at constituency level, MPs are running things through CDF, and then the national government level as well. There's an argument here to be made for collapsing these into one system that will minimize waste and avoid duplication, isn't there?
If we've proposed that in the report, and when you look at the bursaries that are being issued in this country, they are in different levels. You see the presidential secondary school bursary, there is the NGCDF, there is also the county government bursaries. Also, you see some private institutions like banks, like other financial institutions offering bursaries. But now when you look at these bursaries and vis-a-vis capitation of secondary school education, you realize that there are so many gaps and so many inefficiencies in how the bursaries are issued. Like in the report, when you look at the report and in the financial year 23-24, you realize that county governments and intended to issue a bursary of 11.2 billion, but ended up not utilizing 1.29 billion. That means a lot of students or learners who are supposed to benefit from the same did not benefit.
Could you just go into detail on that? Because that's the under-absorption for me really stood out when I was reading this report, because it's pretty straightforward. You've got schools on hand. We know the kids who are going to those schools. They're there regularly, the first term, second term, third term of the year. How then do we end up with a scenario where there's under-absorption, where county government is saying, well, we've not spent this money that we should have allocated to bursaries? And it seems very bizarre.
Something that we cannot even imagine, because when you look at the situation of Kenyans right now, you realize that the governors will not come out and say, we saw that the people are okay, they were able to finance their students, that's why we didn't issue bursaries. So there are so many inefficiencies that are leading to this. You realize that, for example, the NGCDF, same year, they were supposed to issue there around 15 billion. But when you look at 86 counties that were a sample, which is a report by the Auditor General, you realize that between the financial year 21-22 and 23-24, 2.1 billion was unsupported disbursement. The counties have spent 2.12 billion on bursaries, but it's not supported.
In other words, they have no document. 2.4 billion went out of our account.
Yes.
But where do you spend it? How many children received it? What school got it? They can't prove any of that.
Yes, it has unsupported documentation. At the same time, you realize that counties a 722.6 million of unpresented check. So these are checks that have been written, but have not been presented to schools. At the same time, you realize that there is 14.17 of stale checks. So what are we saying? We are looking at bursaries by both counties and GCDF. We are seeing a lot of inefficiencies. We are seeing a lot of poor targeting. It's the same report that is saying that a big percentage of the students that received these bursaries received a multiple bursary. You can imagine a student needing around 50,000 for school fees in 1 year receives 4 bursaries, which are totaling to 80,000. So this student has already overpayment of 30,000. At the same time, there is another student who applied for bursary, but because of the things that are happening, he or she didn't know someone in these offices, didn't receive bursaries. So that's why we are proposing that when you look at capitation, 95% of this money that was meant for capitation was actually used and student benefited. So when you look at the inefficiencies in bursaries and the inefficiencies in capitation, we see capitation as a better option of helping students receive equality in learning.
I just want to move the conversation to the question around drought and widespread hunger, because we covered it a little earlier with Veronica when it came to the impact, the spending that we have on the school feeding program. But drought and widespread hunger, these are key problems that the country faces pretty much every 2, 3, 4 years. But we often leave hundreds of thousands of households without adequate support, even though we do have advanced warning of droughts and we have a national drought management authority that does get allocations year in, year out. What are the systematic issues here that are causing this problem? Because there's a clear disconnect here between how we respond to drought and the amount of money that we're dedicating to responding to drought.
The thing that I can say is we are not effective in planning for these eventualities. We know that we have counties, and especially the assault counties, we know that at this particular time of an year, they will receive these misfortunes. But as a country, we do not have a clear mechanism of effectively planning for this. You will see that we've identified counties that usually face the climate change effect. But again, we leave out so many counties or so many areas that are identical to this. So you look like counties like Taveta, like Baringo, Kitui, and other counties are left out when we are targeting these counties. So when we have such a disaster, we are dealing with Mandera, which we had budgeted for. We are dealing with another county in the northeastern, but now we forget other counties like Taveta. So we end up stretching the resources that we had set aside for these counties to try and mitigate now the impact or the effect that has come to these counties. The other thing is accountability. Yes, we've done this, we've kept this money, but we are not accountable when it comes to offering solutions to these problems. So I think those are the two gaps that we have: effective planning, accountability, and also targeting of the counties that are affected or areas that are affected by drought and other natural calamities.
I want to bring the conversation back to the wider macroeconomic issues with you, Stephanie and Veronica, if you can chip in on this, because assuming we were to draft a budget based on the last fiscal year's revenue, we use that as a sort of hard cap on recurrent expenditure. We say all recurrent expenditure, including transfers to counties, wages, overhead and maintenance, all of that has to fit in within, say, like last year's number, which was around 2.2 trillion Kenyan shillings. If we were to do that, it will be rough. But if we were to do that, what should we prioritize?
Starting with what we've discussed and what I said first, the first would be on the debt obligations. This is because defaulting and also arrears tend to be more costly. So that should be the first. The second bit will be on the core services, as you mentioned, on healthcare, education, security, etc., etc. So that's going to be there. Then the third would be on any high-impact social protection programs, like the school feeding program that we talked about, the household protection programs around cash transfers, especially during drought. That would be the third. And the fourth will be on specifically growth-enabling development spending. That's explainable. And then the fifth will be on the verifiable pending bills. And on the pending bills will be specific to the MSMEs, the SMEs and all that. And then the sixth, and that is only after everything else is concluded, is on new projects. So those are the 6 levels.
Veronica, do you want to jump in?
It would be a very beautiful dream, but one that, sticking to the theme of our shadow budget this year, is quite unrealistic because, for example, County transfers right now are at around 495 billion. So if you remove that, remove the education budget from the 2.2 trillion, we have 1 trillion left out. But then I think we need to revisit the debt conversation and it being a first charge on our consolidated fund. We've been talking about a situation of whether is it that we can't pay or we won't pay. And I think we are drawing closer to the can't pay conversation because of the rising debt service costs. And so I think we need a conversation around debt. But in terms of prioritizing, I think the other conversation we've been having is around pending bills. Shouldn't they also be taken as first charge? For this reason, for a private sector that has been deprived of more than 700 billion, if we were to inject that money back into the economy, I think would go closer to the 5.3 growth target that the National Treasury had. So that would be one area that I would think the government needs to reprioritize. We had a task force that was put in place, but doesn't seem to be meeting our expectations. But then other than settling pending bills, I'd go to health, education, and social protection. Again, a bias based on the work we've been doing at IPF. So those four.
I want to put a follow-up question to both of you, because looking at where we are in terms of debt service and the effect that it has in crowding out other critical spending, just to give our listeners context, for this fiscal year, based on the supplementary budget that was approved by FPs in March, we're now going to be spending around 1.2 trillion Kenyan shillings, 1.2 trillion just on servicing debt for this fiscal year. And as you said earlier, Stephanie, there's been some work. Central Bank, Finance Ministry have been proactive, pushing out some of our maturities. We've seen that with the Exim Bank loan from China to build the SGR, for example, which reduced annual payments by around $215 million a year. And it pushed out maturities, I think, by another 3 or 4 years or thereabouts. But should we start doing the same thing or something comparable in the domestic market? Because the bulk of that 1.2 trillion shillings in debt in interest costs is just in the domestic market. Stephanie, that was for you.
Sorry, so you're asking whether we should do the same in the local market, lengthening maturities and all that, or?
Yeah, pretty much. Because the bulk of that 1.2 trillion in interest service per year is mostly domestic interest. So if you're going to try and create a spending room to give ourselves a bit more relief, we surely have to attack that first.
Yes, it would be good if it's possible to do it in the local market. But then again, I'll go back to a statement I made earlier about the trust. There's no trust or limited trust in the system currently, and that's why majority of investors would prefer playing on the short end of the curve as opposed to the longer end of the curve. So if we're able to address that trust question, the credibility question around fiscal reforms and various policies, and just the debt sustainability question, if we're able to deal with that, then that would be a good push towards the local market. But we don't have that now, and that's why majority of investors would like to play on the short end. The trust question, credibility question remains the overhang as to why it may not be as successful in the local market, that is.
If speaking of the question of building trust, Martin, I want to come back to you. Isn't it long overdue for the Finance Ministry to be giving us very detailed revenue yield estimate for some of the tax proposals that come with to Parliament? Because more often than not, we'll see them coming to Parliament and saying we want to move a tax rate from X to Y, but we rarely ever see the rationale for it, any downside risk assessments, the potential revenue yield. And these are things that our neighbors next door in Tanzania are doing. Shouldn't we be doing the same thing?
I think it is a very high time that our ministers are very clear with us on how we are going to collect our taxes and how we are going to fund our budgets. Because when you look at the most recent information from the taxman, the KRA, we saw that they have already collected about 2 billion of what is expected. But when you look at what is left on the targets that we had and what we have previously been able to get from previous years, for the past 9 years, we have been able to collect at around 8%. So we are supposed to go higher and collect higher with 13%. We are supposed to go higher by 13%, bearing in mind that we have been increasing our tax by around 8%. So the duration that is remaining now and the end of the year, we are supposed to raise this to 13%. So you realize that it's like we cannot do that. So we need the minister to come, tell us we are going to raise this amount, and these are the ways that we are going to use to raise this amount. That way Kenyans will be clear. And when you come to the finance bills also, They should be very clear on how they are going to raise the funds to help us meet the budget requirement. The thing that the minister runs to when we are not able to raise enough tax is debt. And most of this debt is domestic debt. And we've seen from our research that domestic debt is twice as expensive as external debt, which we are not able to get as a country. So we need to get our priorities right and budget for what we can be able to raise so that we avoid that strain and stress of overcrowding the service to mwananchi and using this money to settle debt, as we see in the report.
I want to get to the tail end of this conversation because we're getting into the period where we'll be considering tax policies for the 2026-2027 fiscal year through the finance bill, which will be coming through the floor of the House relatively soon. I want to ask each of my panelists in closing, what are the key policy changes you think we need to see in the 2026 finance bill and why? Veronica, your one recommendation for what we need to focus on, what policy change you'd like to see in the 2026 finance bill?
Allow me to take us back to the medium-term revenue strategy and what two core proposals that were there that the government has hinted at them over time, but then have been left out in finance bills. We are anticipating that the government will finally review the pay tax bands, so expanding the tax bands as well as increasing the tax-free threshold. I think it's a recommendation we have made for the past 4 years as IPF, and we hope it will finally materialize. Other than that, the government had intended to review the VAT rate downwards from 16% to 14%. But then this was supposed to be accompanied by removal of some of zero ratings and exemptions within the VAT Act. It was supposed to be revised over 2 years, the VAT rate, hopefully that it can be revised downwards to 15%, but also accompanied by a removal of some zero ratings that do not directly affect the cost of living for the low-income households.
Martin?
I'll talk about something that we've discussed in this report. Earlier on, Veronica discussed about the taxation on tobacco and the wealth tax. What I would like to see in this finance bill is instead of taxing the things that are so critical to Kenyans or increasing the VAT on them, we need to tax more on things that stretch on our health systems like the tobacco. Because as it was said, consumption of tobacco stretches our health services. So if we tax more, we'll get more money to finance our hospitals. The other thing is about the wealth tax. The government or the ministry should sit down and look at how we can be able to tap something from the wealthy so that we actualize the dream of evenly distribution or redistribution of resources in the country.
Dr. Ngoke?
Now that Martin has said the one thing that I was going to say about the resource raising for health, but the broad picture, I think what we all desire, that businesses as well as economic units, is some form of predictability in terms of the tax regime and in terms of the revenue raising mechanisms by the government to use. Why? Because this allows for planning and for forecasting and projecting of expenditure and so on and so forth. So from the point of view of somebody who would want to look at the Appropriations Act much more in depth, I would really appreciate if we have some kind of a predictable regime for taxation. Because it also allows even multinational companies that are investing in health in the country to plan and to organize the fancy. Think about the pharma companies that are trying to figure out how to meet the market needs in country. Think about the healthcare organizations, both public and private, but especially private health organizations that are trying to figure out how to run in this economy. I think an unpredictable regime tends to affect the delivery of services and the quality of services. So more predictable regime would be really useful. Finance that will be in accordance with the medium-term revenue strategy will be very useful. Thanks.
Stephanie, you get to close out the space today.
I agree with each one's perspective in terms of what needs to come out clearly. But because this is primarily a health conversation, I just want to put this into context. There was some research done over 10 years ago that suggested that out-of-pocket spending on outpatient care in Kenya was roughly around 78%. While inpatient spending was around 22%. This just shows the heavy burden on the regular mwananchi, on almost everyone, on healthcare spending. And in my opinion, I feel if there was transparency in the way that the government was spending our taxes Case in point, what you've mentioned on expected yield and the proceeds and where their spending is going, it will remove that tax fatigue that everyone is feeling like, my income is going into taxes. So just that, the trust is not there. If we're able to improve that transparency, then we could see a lot more people willing to spend because they're seeing where their money is going to.
Indeed. So that's a fairly strong way of closing out the space that we have tonight in partnership, of course, with the Institute for Public Finance here on Mongo Spaces, covering a couple of questions. What should our spending priorities be, especially for the budget coming up for the fiscal year that starts in July 2026. My thanks, of course, to all our speakers tonight, Martin Kabaya, Veronica Ndegwa, Dr. Peter here from IPF, Stephanie Kimani as well. Asanteni Sana for your time and your thoughts. To all of our listeners, thank you for your time this evening.